Okay, welcome back to episode 3. So in this episode now we're going to cover the different time frames and the rationale I use behind them. So we're going to stick to the monthly chart for this video. So for me, the monthly chart is mainly used for your overall direction, your macro direction, which for me is long term, and also can be used in the same way as all the other time frames for obviously continuations or reversals, trade setups, market structure. Also can be used as entry points depending on how long you wish to take the trade. So if you was going to take a trade based off the monthly chart, for me that's more of a positional trade. That's more what I would call an investment, as you're going to be looking to hold it for weeks, months, even going into years. So for example, if you took a long position on euro dollar, so exact same thing we was going into in the first video, but you're just applying it to our monthly chart. So I'll go through what I mean using this price action. So if you're looking at euro dollar here and you're saying to yourself, okay, we have taken out these two lows. We've obviously failed to close below 1.05 on 1, 2, 3, 4 occasions. So the way our edge tells us to trade or to place a trade is that now should be our pinned in low. And now we're looking at our high. So when we use our fib here, we can see we had a pullback right down into 1.05, and our level of invalidation should be 1.03400. So in terms of risk to reward, in terms of a swing trade, how now would you plot this trade or use that information? So if you're taking it on the monthly, you've waited for that monthly to close, and the monthly has closed right here, and now you've taken that long position. So your long position would be coming in here. So it's the same rules for every time frame. Wait for that candle to close. So we've waited for our monthly chart to close, and now we're taking our long position right here. Our level of invalidation would be this low right here. So this is 236 pips. If we apply back our Fibonacci retracement tool, we're looking at a target of here, which is nearly around 750 pips. So you can see that is quite a swing trade. 750 pips, which would offer you a 3.18 risk to reward, and you would have been in that trade for 1, 2, 3, nearly 2.5 going into 3 months. So for me, that is a swing trade. But if you were holding this trade and you was obviously moving your stop loss in accordance with the trend, which is something that we're going to cover later on, then how would you manage this trade? So when we look at our projection targets for price, so we can say this is another way I look at it is our line chart. So I would say to myself, that's our high, that's our low, and that's our high. So you can see on average we're around the 887 pip range, even though we know at worst it's 1000, just at 1000 pips give or take, but 800 pips would be, that's the minimum you could expect. So once we bring it back to that line chart and we see price breaks through that area, so let's put it right on top, which would be here, you can see it's no coincidence that 800 pips give or take later was the market reversal. So again, like I said to you, market participants are predictable and do react in the same way. So essentially, once we break out of this range environment here, we would be looking for, so we got our range, so we would be looking for price to break above. So if we had a breakout here, now we know, typically speaking, ranges expand. So what I mean by that is that range is going to expand up into this range, and then you can see that's almost identical what happened. We just had a monthly range expansion, which could have seen you holding euro for more than a year. So if we look at where you would have got in, it would have been around March 2017, and you would have been holding for April, May, June, July, August, September, October, November, December, January, February. So around nearly a whole year of holding price, and that would have given you back a 7.46. So initially you was risking 236 pips for a maximum target of 1,760 pips. So you can see the range expansion that came in. You can see what happened. Price rallied right back up. We did have a little bit of an overextension. Exhaustion came in and we fell and rejected. So that's just showing you how you can use the monthly time frame as a nice swing and also as a level of clarity. It just provides a lot of clarity. The higher you go up in time frame, the more clarity you'll see. So even when we look at euro dollar here, for me, some people will see reversal. All I potentially see is just a healthy pullback. So we just, after such a rally on that month, you can see that's a strong candle. We just had a little period here of monthly indecision, which created that range very similar, should I say, to the 1.05 area. All we did was just kind of whip those lows, just kind of take those lows out, and then you see again, we rallied back down, so we broke below, rallied back up, higher low came in, and then we've seen another push higher as the trend isn't yet ending because we haven't had the structure for price to end. So we haven't seen a clear break and then a retest below. All we've seen is price. We did see price close in the round, but you have to look at the actual characteristics of the candle. The price isn't closed by far. You need to see a strong candle close below, and that will let you know that the shift has come in the market. So it's practically the same thing again. That monthly candle here, and then we've seen price pull right back down into where 1.17500, and then we've seen your target would have been at the top of that range at 1.20704, which shows you price is not random. And if you look at our targets, they practically, our fourth target, which is our reversal level, practically is right where price reverses. Again, if we even zoom into our line chart, so line chart's not valid in that scenario. So if we look at our candlestick chart here, we see that was a 400 pip expansion, and then we look at price again, and what do you see? 400 pip expansion right to the top, and then we see price start to reverse. So you can see price is not random. It's not random. The same thing happens over and over. It just happens in a different way. When you're looking at again structure of price, you now see we've got a strong up candle. We've got the same characteristics again. However, this time is very different compared to the times where the pattern failed. So if you see on that occasion here, price didn't really close below that level with no conviction. On this occasion, price created a series of lower highs, as you can see here. We almost had this tweezer top reversal, and then we had a lower high, and the lows. So when we see this candle here, for me, isn't a trigger to get in. As you see, that month ended up rallying right back up, so no one wouldn't have had a stop loss right back above 1.26 unless you're obviously a position or swing trader, long-term trader. So your trigger would be, once you've seen this monthly candle close below, that is now your monthly breakout. So if you was a swing or a position trader again, you're waiting for that monthly candle to close, because now you've got your macro direction. So this trade or this position, it can be relatively small. It doesn't have to be you're risking 1%. You could just get into the swing of learning how to let trades play. So you're risking here, so your stop has to be above last month's high. So that would offer you 339 pips. Then when you look at the rejection that we got, we're now looking at price has showed you structures breaking. So your next monthly downside target would be this red line here. So your first target you'll be looking at is around 1.15. So what does that offer you? A 1.6 return, which is not what we look for. So you would have to monitor your trade at this level. So you wouldn't have to necessarily close. but you would have to monitor. As you see, we had 1, 2, 3, 4 months of what I like to call consolidation or more, or also it's consolidation, but for me it's just a break in the market. So you can see market participants just have a break after such a rally. Consolidation will usually lead to an expansion, and then you see what happens. Price moves right back down into our next level, which now starts to be a high yielding trade. So you can see we've got 2.5 return, and then we come down again into our next level. We've now got a 3.1, and at most we would have had a 3.5. So that's if you're going with the swing aspect and watching how price structure changes. So again, when we go down into this monthly chart here, so we see our first consolidation with that break. We come over into our second period of consolidation, which is around here. We see the same thing again. We've got this monthly candle here. Consolidation, wick below. Reason why I say is to wait for that monthly to close. Monthly close right back in here. We rallied back up. But when we got that nice monthly candle close, which is that breakout candle, what do? Same thing. Apply our fib again to that monthly candle breakout, which is going to take us, right here. And then we're looking at our pullback. So when we've had that breakout, we're looking for that monthly retracement. So you see anywhere into that 61, that 1.15 level for me is a key area for shorts. So we've got that nice key area for shorts here. 1 second. So we've got a nice key area for shorts at 1.15. So where are we looking to place our stops? Stop loss needs to be above that monthly high because we're trading based off the monthly chart. So that's what you need to remember. Whatever time frame you're taking a trade off, that's where you need to place your stop loss. Don't try and cheat the market. And then we're looking at our next downside target, which would be where? 1.1. So you see on that occasion, that's a perfect example of you've seen consolidation, you've seen that expansion down, you're now looking for the retracement back up. Ideal, we're looking for euro. We know euro lags between 61 to 70.4, 74.4 more often than not. On that occasion, we did get a rally up to 82.8, but you can see stop loss is at 1.6248, which is that monthly high. Didn't come near that stop loss, and then we've got price moving down lower, and you can see where our third target would have been, which would have offered you a 4.5. When you continue down, euro again, so let's have another look. So we look at euro again in terms of the structure. This occasion here, what do we have? We've got practically the same candle. So that candle rejected directly off 1.15. We had 1, 2, 3, 4, 5, 6, nearly 6 months of prices being in that monthly range between 1.15 and 1.125. When we had that candle close below, you can see we had that nice candle close below, price drop below. But what we're looking for, we're not looking to sell low. That's just our trigger. So understand what I mean by that. That is your trigger for price to let you know where price is going. So upon that level here, you can either use that as your next high, or this. For me, on this occasion, I would use here as my last high. And then we're looking for the low where price will trace down to. So this is our monthly trading. So we see our swing high, our swing low. Price broke that low and showed us now sellers want to take price lower, but we don't want to sell low. So we wait for that pull back up. This time, perfect rejection right back into 0.61, 0.66. And then we see target 1 fulfilled, nearly target 2 fulfilled. So that would probably be around 2.5 to 3 risk and reward. So if we're looking for price to return back and we got an ideal entry, stop loss would have to be above there because it's a swing trade. First target where would we be looking at? Right there. So let's just see what our risk and reward would have been. So our risk and reward for this, so we're entering price at 0.6 here. Stop loss again above that monthly high, 156 pips. Target, first target here 2.7, second target 3.3, and if we did obviously hit our third target, would have been 1.075, would have been another 4%. So looking at euro right now, what can we see? That's why I said I like leading on from the first episode, why I listen to always monthly structure, because monthly structure is key. And when you look at our monthly chart on euro right now, we are still in a bearish environment until we get the opposite of what I've just shown you on the bearish side. Until we get a break above 1.141, this is just a counter trend trade, meaning we're going, obviously because it is the monthly chart, we can buy the so-called B legs, we can buy the pullbacks, because in terms of weekly and daily, they are going to be a good amount of pips. So you wouldn't want to just miss out on hundreds of pips because your overall bias is short. But you just be aware that the overall trend is still bearish until we get above 1.41. Right now, all this is a discount on price to sellers. So like I said, to look at it, that's the highest, that's the most expensive, that's the cheapest you can get. And now all you're looking at is a discount. So once price starts to pull back up, we've gone past 30%, 50% off. Right now we're in a 60 to 70% sell. We can get into 70 to 80s or even a 93% sell. But once we go past 1.14, buyers now, this is too expensive. This is too expensive for sellers, sorry. So now it will turn into a bull market. So right now, I think euro dollar, until we get above 1.14, this is just a correction, and we should be looking at another leg down to 1.07500 if we do see the rejection and the continuation of the trend that we've seen happen before. So I hope this video was very insightful for you to understand how to use the monthly chart, and the next episode will go into the weekly chart. Thanks for watching, and I hope you enjoyed this video.